Okay. 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 So we are live, right? So first and foremost, right? Thank you everyone for coming down to today's session, right? A big thank you to Mauricio, FX Street and Desi, right, for helping me organize this webinar. So my name is Rayner, right? I'm from TradingwithRayner.com, and today's webinar is basically to give you to teach you some essential technical analysis skills to help you, increase your win rate and to anticipate so-called predict market turning points. So this will be our key highlight for today's webinar. So a little bit about myself, right? My name is Rayner. I'm an independent trader, right? I trade for myself, and I was an ex-prop trader, right? I used to work for a proprietary trading firm, and mainly I was dealing in the futures market. So right now, in today's context, right, I'm basically trading the forex and futures market. My trading methodology is mainly trend following, right? I like to trade with the trend. So if you want to learn more about where to find me, these are some links, my website tradingwithrayner.com, and this is where you can actually reach out to me. So that's a little bit about myself, right? I don't really want to go into extensive details and everything, right? If you want to really learn my story, my background, you can just check out my website and the full detail is over there. So nonetheless, right, today's session, right, is basically, right, teaching you the essentials of technical analysis, right? As you know, right, technical analysis is very broad, right? You have indicators from A to Z, and if you ask me, right, in my early years of trading, I've basically studied almost every indicator, tools, concepts, the ADX, the ATR, RSI, Bollinger Bands, everything. I've just played around with it, tried, tested it, and if you ask me, right, the key thing that actually made me a consistently profitable trader is to declutter my trading. So whatever that I've learned, right, I've actually basically throw away 90% of the stuff that I've learned, and I just simply keep the remaining 10%. So in today's webinar, right, I'm going to share with you what some of these 10% are. I can't cover everything, right, but if you ask me, these are definitely the essential techniques, right, and concepts that you have to understand as a trader. Okay, and the first one that we're going to be talking about is support and resistance, right? This is possibly something that you are probably familiar with, right? So I want you to know that firstly, support and resistance, they are areas on your chart, right? They are areas. So they are not levels or anything like that, but areas. And the reason why they are areas is because, okay, let me try to get this drawing tool. Okay, let's see. Well, can't seem to get the tool out. Never mind. The key thing why they are areas on your chart is because sometimes traders may look to enter a market earlier, right? For example, those who want to buy before the price reach support, they will look to get long. And sometimes there's another group of traders who will look to get long only after price has breach or rather trade below support. So when you have these two group of traders coming together, what happens is that support becomes an area, right? Traders who are looking to get in early and traders who are looking to get in later. Okay, so this is the first thing. Second thing, right? Trading from support and resistance, it gives you a favorable risk to reward. Right, I explain more later on, right? And firstly, right, I think what is key over here is to basically, to learn how not to draw support resistance, right? So let me get up my trading charting platform and I'll share this with you. Okay, let's see. This over here, right? This is just a demo platform, right? From Pepperstone, a broker. You can download this MT4 platform if you wish to. So let's say, for example, I get out the euro dollar. Okay. And let's say, typically how most traders would draw support resistance, right, is that they will, go on to, let's say, the weekly time frame. They plot out their lines. Okay. Then they go down to a lower time frame like the daily, they continue plotting their support resistance. And, maybe this time around, it changed color to red, right? Then they start plotting all the obvious levels on daily. Okay. Like this over here, this low. Okay, so once that is done, again, you go down to a lower time frame like the 4 hour, right? Again, you start plotting whatever levels that you can see. Right, maybe this time around we change color to purple, right? On the 4 hour. There's one over here, this low. Maybe this one as well. Then you go down to the 1 hour. Again, you can see more levels coming in. All right, maybe this time around, you notice that this is another one. Let's change this to green. Okay, and you keep doing this until all the way down to the 15 minutes time frame, which you can even see the more finer detail on your support resistance level. Maybe you have it blue this time around. Okay, so what happens is this, right? If you go, let's say your entry time frame is a daily, and you go up to the daily time frame, your support resistance is going to look something like this, right? You have different levels, right? Very near one another. And the issue with this is, how are you going to trade? Right, like for example, right now price is approaching this purple line, which is possibly a resistance on a lower time frame, and you ask yourself, should I be long because it's coming into an area of resistance? Then slightly below, you have this blue line over here, which could be a level of support on the lower time frame. Right, so you can see that price is basically near support and resistance. They are near many levels that are actually on your chart, and it makes trading difficult because you have no idea which levels you should be trading. Because there's just too many levels, right? You get analysis paralysis, right? You're paralyzed by your lines on your chart. So this is basically how you should not draw support resistance, all right? This is the wrong way to do so, if you ask me, right? So what is the right way? Let me share this with you, okay? So the right way to do it is, I'm going to share with you 3 pointers on how to do so, right? Number one, you want to break down your trading into 2 time frame. Number one is the entry time frame. Number two is the higher time frame. So when you are drawing your support resistance, you just want to focus on these 2 time frames only. Anything else outside of this time frame is noise. Okay, that's one. Second thing, you want to pay attention to the number of touches, that your support and resistance hits. That means you want to draw your support resistance levels to accommodate as many touches as possible. Okay, the more touches, the better. And the third thing you want to take into consideration is the magnitude, right? How much did price move away from a level, right? So these are the 3 things that I would take into consideration when I'm drawing my support resistance. All right. So let me use these 3 principles that I've shared with you, and we redo it again for euro dollar. Right, so let's say, for example, I like to trade off the daily time frame. So the daily chart is my entry time frame, okay, and the weekly chart is my higher time frame. So what I'll do is, again, I'll just zoom out on the weekly, right, and I'll start plotting my levels of the weekly chart first, right? So you want to have different colors for different time frames. So for the weekly, let's say I put it to red. All right, so let's say, okay, you can see that for the weekly, I would draw the first level. Let's say we start here. Okay, so over here, you can see I got 1 touch over here, 2 touch, 3 touch, and maybe 4 over here, even though there's a false break over here, 4 touch. But if I push it down lower, let's see if I can get more touches. If I push it down lower, I have 1 touch, 2, 3, 4. Okay, and if you include these 2 false break, 5 and 6, right? I'll consider this. Well, this is a little bit subjective whether you consider this a touch, because price actually break beyond it and then close below it, right? So for me, right, I would say I wouldn't consider this because the break was way too large to consider a touch. So in this instance, you have 1, 2, 3, 4 touch, same as the previous one. But I'll leave the line at this level over here because this is the most recent price action, right? It has taken into consideration the most 3 recent touches, which is this 1 touch, 2, and 3. Okay, so let's draw the next level. How about this? Right, you can see that I won't draw it at this high, because if I push it down a little lower, I can get this one over here, 1 touch, 2, 3, 4, 5, and this maybe even 6. Okay, if I push it up a little, let's see. Okay, I think this looks tighter because you can even get this one over here, this one behind. So 1 touch, 2, 3, 4, 5, 6. This one is a false break, whether you consider it or not, right? I would say it's discretionary. Okay. So again, we can bring it down over here. Same thing, right? I don't want to put it at this high. I want to bring it down lower to get as many touches as possible. So I have 1 over here, 1 touch, 2 touch. If I bring it down even lower, right? You can see I have 1, maybe even lower a little bit. 1, 2, 3, 4, 5, 6 touch, right? See how I would actually curve fit my levels to get as many touches as possible on the chart, right? This as well, right? Bring it up a little over here. 1 touch, 2, 3, and 4. Okay, so I think there's another one here. Same thing. If I bring it down lower, 1 and 2. Okay, so I'm pretty much done for the weekly, right? I like to just plot out the most obvious levels on the weekly time frame. If you need to, squint your eyes and to decide and think, is there really a level down there? Then chances are, the level isn't significant enough to take note of, right? So if that's the case, right, then we'll move down into our lower time frame, the entry time frame, to further plot our levels, right? So on this time frame, again, the same principle applies. You want to get as many touches as possible, right? You want to pay attention the magnitude as price leave a level, right? The greater the distance price has left the level, right, the more significant that level becomes. Okay, so let's say this time frame I change to black to signify the difference. So for this over here, I have this as well, right? We have 1 touch, 2, and 3. Okay, I can see one over here. If I push it up, push it down over here, I get 1 touch, 2, 3, 4. 4 touches. How about this? So you can see I'm basically doing this live with you, right? I have no idea how the chart will look like, so I'm just drawing all this right now. So this as well, right? You can see 1 over here, 1 touch, 2, 3, 4, 5, 6, 7, 8, 9, 10. It's quite a number of touches, so this is definitely a key level to look for. Okay, so what else? How about this? Yep, right. You have 1 touch here. 1, 2, 3, 4, 5. Okay. So another tip that I want to share with you is that in the FX markets, right, the market tends to respect a even number, which is 0, 0, and 5, 0. So you can actually tweak this, your levels, right, to actually accommodate this 0, 0, and 5, 0 levels. So let me share with you an example, right? Like for example, this one right now, the level is 1.1141. Maybe I can change this to 5, 0 and see how it looks like, right? So 5, 0, right, it's at the half the midpoint. So this is something that you can adjust as well. Like this was 10872. Maybe we can change this to I think 75 would be a better fit. Right? Sometimes it may be quarter as well. Quarter 25, 75. This one will be 0798. I think just change this to 08. Right? Round number. For this, you can 1053. Maybe you can leave it as 10525. Right? Just to tighten up all these levels. 10368. So maybe 10375. And yeah, I believe you get my point. 11466, right? Maybe you can have 114, how about 50? Pretty decent. Okay. So yeah, so basically right now, right, you can see that my chart on euro dollar is very much different from the chart you've seen earlier. Right, since I'm trading off the daily time frame, my thought process would be something like this. If euro dollar can get into this level, right, this area of resistance, then I will look for a shorting opportunity, right, for this market to continue trading lower. So all that's left to do now is just basically to wait for price to come to your level. All right, but the important thing is that you have to get your level correct in the first place, right? If not, you're basically trading off the wrong levels. Okay, so this is basically how I would draw my support and resistance. All right, let's move on. Okay, so next thing I want to share with you is what I call the 4 stages of the markets. All right, so the thing about trading, or rather the thing about financial markets, is that I'm sure you know by now is that it doesn't go up in one straight line, right? It zigzags its way around, right? So the 4 stages basically represents the way the market zigzags around in the different market conditions, right? And it appears in different time frames, different markets. So first stage is what I call the accumulation stage. Second is what I call the advancing stage. Third one is the distribution, and the fourth one is the declining stage. So I'm going into more details, what this looks like. All right, the accumulation, well, this should be stage, right? But here is put phase. Maybe I can just edit this for a quick one. Okay, let's see. Accumulation stage. Okay. Okay, so the accumulation stage is basically arrange markets in a downtrend, right? The ratio of bullish to bearish candles are pretty much similar, right? Your 50 period moving average would start to flatten, and price tends to whip back and forth around the 50 period moving average. So if you want to look at a chart, it looks something like this. You can see that this is an existing downtrend. Then the market goes into a range, right? The 50 MA is starting to flatten as well. So this is a potential accumulation stage. And the thing is this, right, is that there is no way you can tell for sure that this is an accumulation stage, right? But there are certain techniques that you can use to increase the odds of this being a potential so-called bottom on this time frame. So I'll share that with you later on, right? But for now, just have an understanding of what a potential accumulation stage looks like. It's basically a range market in an existing downtrend. And the key thing is that your 50 period moving average will be starting to flatten out. All right. Next stage, advancing stage. This is just basically an uptrend, right? So your bullish candles are usually larger than your bearish candles, all right? Your 50 period moving average is pointing higher. And it looks something like this, very straightforward uptrend, right? Higher highs, higher lows. And after the advancing stage, what happens is that the market goes into a distribution stage and is basically a range in an uptrend. So if you think about this, this is actually the opposite of the accumulation stage. All right. And your ratio of bullish to bearish candles are, similar, right? Your 50 period moving average is starting to flatten out, and price tends to whip back and forth around the 50 period moving average. This happens because the market goes into a range. So when the market goes into a range, right, you know that, it tends to, trade and whip up and down, beyond the moving average. So it looks something like this, right? You have an existing uptrend, and the market goes into a range. And if you look at the moving average, the 50 period moving average, starting to flatten out, starting to point lower, right? So this is a potential distribution stage. And likewise, similar to the accumulation stage, you have no idea, right? Whether this will be whether the market will break lower or break higher. But you can actually use certain techniques, which I'll share with you later, on how to actually determine the likelihood of it breaking lower. So declining stage, the last one, is basically a downtrend, right? Bearish candles are larger than the bullish candles. The 50 period moving average is pointing lower, and it looks like this, right? Lower lows, lower highs, basically a downtrend. So you can see that this is basically the 4 stages of the market, and they link from one to another. So if you think about this, right, what happens after the declining stage? Well, the market goes into a range, and if it does breaks out of the range, right? I mean, if the market goes into a range, it becomes a potential accumulation stage. And if it does breaks out of the accumulation stage, it goes into the advancing stage. So this is how the 4 stages basically links with one another. Okay, so that basically gives you an idea of how the market moves, the 4 stages that you want to be aware of, right? And this will gives you a good foundation into what to expect when you're trading the markets. Because once you have this understanding of these individual stages, then you will know what is the best course of action in each scenario. For example, the declining stage. You know that since a declining stage leads to lower prices, you want to be looking to short in this market condition. Okay, or how about you talk about the distribution stage? If you have a conviction that this could be a potential top in the market, then you could actually look to either short the breakdown of this area of support, or if the market does retrace back towards this level of resistance, you can look to short in anticipation of lower prices. So I guess the key message I want to bring across is that once you've understood, right, what stage the market is in right now, then you can actually decide what is the best course of action for your trading at this point in time. Okay, so moving on, right, I want to talk about candlestick patterns, right? So candlestick patterns is, again, to me, it's important, but not the most important when it comes to trading. So firstly, right, I just want to share with you what are some of the limitations of it, and later on we'll move on into how to actually read candlestick patterns without memorizing all the different formation names. First thing about candlestick patterns is that tweaking is required. Okay. Second thing is that it doesn't tell you how the price move. And third thing is that it ignores the big picture. Right. So what do I mean by tweaking is required? I need my drawing tool for this, right? So let's see if I can use something that's available on PowerPoint. Okay, how about this home? I think this is not bad. Tweaking is, can I draw? Okay, yep, I can draw this. Okay, so you know traditionally, right? If you trade candlestick patterns, okay, I think is there a pen tool? Okay, I can't seem to get the pen tool out. So what I'll do instead is I'll just use this manner, right? So you know that traditionally candlestick patterns, they usually have a gap in between, like this one over here, and maybe you have this over here. So pardon the color, this should be green, right? Let's change this to green. Oops. Format, shape, color, green. Okay, something like this. Okay, so this is typically, what do they call this? Is this a evening star, right? Correct me if I'm wrong, but this I think is an evening star. Right, just to double check. Okay, evening star, right? This is correct, right? So, like as I said, right, I don't memorize candlestick patterns, so sometimes the names, right? I'm not really sure what the names are, but I can read them, but I don't memorize them. So this is a textbook example of an evening star. It appears commonly in the stock markets, but when you trade the FX markets, right, you need to tweak this pattern because in the FX markets, you don't have much gaps unless it's the weekend gaps because it's traded, Monday to Friday, 24/5, right? So what you need to do is that if you want to trade evening star in the FX market, you need to tweak this pattern. So what you'll do is to remove the gaps in this pattern. So you'll look something like this instead, right? You shift this higher and this higher, right? Now that the gap is removed, right? It will look much closer to this right now. So this is what I mean by tweaking is required when you are, trading forex candlestick pattern, right? Bear this in mind. You can't just take the traditional candlestick pattern that involves gap and just bring over to the FX market. You need to remove that gap to give you a redefined definition of what candlestick patterns is for the forex market. Second thing, right? How did price move, right? This is another important one. So let's say, for example, the market closes lower. Okay, so what it does not tell you is that, how did price move from the open to the close, right? Did it move like this, right? Traded up higher, then it finally closed lower over here, or maybe it moved like this all the way down, then it goes up, then it comes back down, goes back up, and finally comes back and close lower over here. Right, this is another possibility, right? Or likewise, it could be, it comes all the way down, all the way back up, and then smashes all the way down lower again. So you can see that, candlestick pattern does not tell you how did price move on the micro picture, right? On the lower, on the candlestick itself, the body will not tell you how the price move. The only way to find out how it moved is to actually go down into a lower time frame. So this is another limitation of candlestick pattern that you want to bear in mind. And why is this important is because if you ask me, the way price move, right, will give you a clue into what could possibly happen in the near future. Like for example, like this one over here, if you talk about lower prices, I would say this pattern over here, right, has a more likelihood of prices trading lower because you have some form of build up over here at the lows. What is build up? Build up is basically, consolidation near the highs or lows. So once you have consolidation near the lows, right, the likelihood of the market trading lower is higher because traders who are long would have their stop loss just below these lows. So when it puncture through the lows, right, this cluster of stops will get triggered, which would fuel further price decline. Right? If you compare to this third one over here, this formation over here, it won't be as what do you call it, as bearish, because over here at this low, there will be traders looking to get long, and they could buy it after this steep decline, and price could possibly just reverse higher from here. So the way price move, right, how did price move, right, would have different implications into what is likely to happen in the near future. So this is why I would say it's important to know how did price move, right? And candlestick pattern, again, right, it does not tell you based on judging how it opened to the close. Okay, the third thing, ignores the big picture, right? This is another one, right? So I'm sure candlestick patterns, they have different meaning. Like, for example, you see a engulfing pattern. A bullish engulfing pattern means it's bullish, right? Like this is, maybe let's call this a bullish pin bar or a bullish hammer. It's if you just judge it based on the candlestick pattern, it is bullish. But one thing is that you don't want to just judge whether the market is bullish based on just a single candlestick pattern, right? The best way to do so is look at the big picture. Look at the trend. What is the trend doing? What is it telling you? That would give you a more so-called predictive, I would say a more higher probability of determining what is likely to happen next. So for example, if you look at this chart over here, this is in a downtrend, right? So just because you see this bullish bar over here, you don't want to think that the market is going to reverse and you're going to be looking to long. Instead, you still want to follow the trend, right? Is that the trend is down, you still want to stay short. So again, you want to be careful with regards to candlestick pattern. Don't read them in isolation, don't trade them in isolation, right? You still want to look at what is the big picture, otherwise known as the trend. Okay, so how do you actually read candlesticks, right? Like a pro. First thing first, right? Three things that I need to share with you, right? You want to look at where it closed relative to its range. What is the size of the candle relative to the current swing? And the length of the wick relative to the body. So this is very straightforward, right? If price closes near the top 1/3 of the range of the candle, right, then it is bullish momentarily, right? At this moment, at this point in time, right, the bulls are in control. So momentarily, right, this is bullish. If price closes in the middle of the range, then it's basically undecided, right? Means the bulls, the buyers and sellers are pretty much in equilibrium. And if price closes near the bottom of the range, right, it is bearish, right, showing you that momentarily, right, the sellers are in control. Remember, I use the keyword here, momentarily, because it's just for this moment, right? If you want to know what is the market likely to do over the next 10, 20, 30 candles, look at what is the trend. That will give you a much more accurate picture. Okay, so let's look into this point again. At this point again, size of candle relative to the current swing. So you can see over here, right? This over here is a bullish candle. This is a bullish candle. Okay, but if you ask me, right, is there anything to signal that this move is going to be over? This down move is going to be over? I would say no, right? Because if you think about this, the size of this retracement candle is pretty much similar to the current swing. So this is what I mean by size of the candle relative to the current swing. If the range of the candle is pretty much similar to the current swing in the market, then it's telling you that there's nothing too suspicious going on. There's nothing that you should concern yourself with, and you should actually expect the momentum of the current swing to continue lower. But if you get a huge candle that is largely different from the current swing, right, then this is a sign that's telling you that maybe something is changing, right? Structurally, right, something is changing in this market, and you can actually alert yourself to actually any potential trend, any potential change in the current momentum or trend. Okay, so this is what I mean by pay attention to the size of the candle relative to the current swing. Second thing, length of wick relative to the body, right? This basically tells you price rejection, right? The longer the wick, the greater the price rejection, right? So what is the length of the wick relative to the body? If the wick is at least 2 times longer than the body of the candle, it's telling you that price is being rejected, either rejecting higher prices or rejecting lower prices. All right, you can see over here a very typical price rejection, right? This wick here is so many times longer than the length of the body, right? So this is a rejection of higher prices. Some traders have a name for, like, a pin bar, a Pinocchio bar. What else? a shooting star. Is it shooting star, right? Again, so there are different names to this form of rejection, and I guess the key thing is to understand that price is just basically being rejected. Whatever you call the pattern is not important, right? But understand that it's rejecting higher prices. So I want to move on into this section over here called time price analysis. Okay, so basically it's to help you identify strength and weakness in the markets. For example, right, if you look over here, okay, you can see that you have an uptrend, right? A series of higher highs, higher lows, right? However, where I want to alert to you is this portion over here, this swing over here. Notice that this is the first swing that took out the previous low, right? And it hasn't happened prior to this, up move over here. So this is a clue, right, that the sellers are possibly in control because it has actually broken below the previous swing. And look at this retracement over here, right? This is another key thing over here because notice the number of candles that is actually trying to trade higher. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. After 11 candles, right, the price has actually not even been able to retest back this highs over here. Right, if you think about this, within 3 candles, 1, 2, and 3 bearish candles has actually pushed price down lower by this much. And after 11 candles, after 11 retracement candles, right, the bulls are unable to take back, or rather they are unable to push price back towards the highs over here, or these highs over here. So what is this telling you? This is telling you that at this point in time, right, the sellers are in control, right? Because it took them only 3 candles to push price down by this much. And for the bulls, right, after 11 candles, which is this portion over here, they're still unable to take back price towards the highs. So this, if you ask me, right, is a sign of weakness by the bulls, right? This could tell you that this current uptrend could be coming to an end. Okay, another example you can see over here. You have an uptrend, then you have this range, and then the price broke out of the range. So again, same thing, right? The sellers came in, pushed price down towards this area of support. And what about the bulls, right? You can see that after quite a long period of time, right, they are still unable to push price above support, or rather they can unable to push price higher than where it currently is. It's still at this area of support after 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. After 17 candles, right, the market is still unable to trade higher, even though it's an area of support, right? Even though it is currently at an area of support, after 17 candles, it is still at this level. So what is this telling you? This is telling you that the market has found equilibrium at this level of support, right? And chances are there would be a cluster of stops below this low, and below this low from traders who are long. So what do you think will happen if price were to trade below the lows? Chances are this is going to fuel further momentum towards the downside as this cluster of stops are being triggered. So if you ask me, right, this is a sign of weakness by the bulls again, right? Because they are unable to push price higher, and you have this cluster of stops below, right? If triggered, right, would fuel further price decline. Okay, so this is basically, right, what I mean by how to actually read candlestick patterns, right? You want to think about how the price move, right? Is it still at this level after a long period of time? All right, look at the retracement move. Is it getting steeper? Is it getting stronger? Right? So this will give you a clue into how to actually read candlestick patterns. So before I finish off, right, I just want to share with you what I promised you earlier into how to actually predict whether the market is in a accumulation or distribution stage. And the key thing, right, the key technique that you want to pay attention to is this. Wait for the market to approach support resistance on the higher time frame. So basically what you're trying to accomplish here, or rather you're trying to do, is to make sure that in a potential accumulation stage, right, it is actually leaning against a higher time frame support resistance. Okay, so let me give you an example to show you what I mean. So in this example, you can see that New Zealand dollar has basically pulled back into this area of support on the daily time frame. Okay, so when you go down to a lower time frame, like the 1 hour time frame, you can see that what is this? A potential accumulation stage, right? Because if you draw a couple of lines, right, you know that this is in a range. And if you pull out the 50 period moving average, it is getting flatter. So you can actually have somewhat of a confidence because you have confluence of the higher time frame support, which is this red line over here. So this gives you conviction that, hey, this could possibly be a bottom in this market for New Zealand dollar on this current time frame. So this is the technique that I use to actually help determine whether the market is bottoming or topping out, right? Because you're leaning against a higher time frame support resistance, right? So on this chart, you can see that this is the red line, which is the same red line that you're seeing over here on the daily time frame. Okay, so this is how you actually, so-called predict market turning points by using the 4 stages of the market that I've just taught you and leaning against the higher time frame support resistance. Another example you can see over here, pound dollar. Excuse me. Pound dollar daily resistance, you can see again, right? Price coming to this level. Okay, so this red line is the daily resistance. And on the lower time frame, what you can see? Well, we talk about the time price analysis, right? Look at the retracement by the bulls, right? After so many candles, it is still unable to retest back these highs over here. So if you ask me, right, the sellers are in control right now. So when it broke below this low, this would be an opportunity to actually go short. And once again, right, you can actually lean against the higher time frame resistance over here. Okay. Another example, right? You can see that 30-year treasury bond. This is a level of support on the daily time frame. You go down to a lower time frame, you see this, right? A range over here, and the market broke out of it, right? You can be more confident that this could be a potential accumulation stage because you're actually leaning against the higher time frame support. So you can actually be more convinced to actually trade the breakout of this market in anticipation that this is possibly the bottom of this 30-year treasury bond on this 4-hour time frame. Okay, so let's do a quick recap on what we've covered today, right? Number one, I've shared with you support resistance, right? What it is, how not to draw it, and what is the correct way to draw it, right? The correct way to do it is, the way I do it is to have 2 time frames, to try to get as many touches as possible, and to pay attention to the magnitude of a level, right? The greater price has moved away from a level, right? The more significant that level will be, and also that is something that you want to take note of. Second thing, I share with you the limitations of Forex candlestick pattern, right? I share with you that you need to tweak it from traditional stock market to the Forex market. Hey, I talk about the fact that it ignores the big picture, and I also shared with you, right, that candlestick patterns does not tell you how did price move from the open to the close. That is something that you have to look for in the lower time frame. Then we talk about how to actually read candlestick patterns. All right, I share with you time price analysis, and then we combine all that we have learned so far today into anticipating market turning points. Right, the key thing is if there is a potential accumulation stage that you see on your chart right now, you have to go up to a higher time frame and see whether it is leaning against any support level. If it is, right, then there's a good chance that it is possibly bottoming out, right, on the time frame that you're looking for the accumulation stage. Okay, so yep, that's all I have for you in today's presentation, right? If there's anything, right, you can just drop me an email. All right, you can just find me at www.tradingwithrayner.com. Right, that is where you can actually reach out to me if any questions or any feedback or anything, right? This is a place to look for me. Okay, so with that, right, thank you all for your time, and let's see if we have any questions. I don't think we have. So Desi, could we conclude today's session, Desi?